Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk about our stock market investment strategy utilizing closed-end funds. So to get the normal disclaimers out of the way, this is an unedited video. So who knows what you'll hear in the background as I film these in my house. I mean, chances are you'll hear any number of things as we get ready for another week. So what else? So I am not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So here's the update from the week. I am working on writing three books at the same time, and I've got, of all things, I have the two breakout books, I think mostly edited. I'm currently working on the 12 steps book, and it's a process. It's a fun process. It's a challenging process, um, but it's a process. The good news is that I am making progress. Um, this week was hard, to be honest. Um, I found I used to describe my life and my work environment as the juggler who ends up just spinning plates on everything. Like he's spinning plates in either hand. He's got a stick on his nose, two more off his cheeks, and he's just juggling plates like crazy. And that's kind of how my life used to feel. And it's so much different and so much better now. But at the same time, this last week was maybe more wearing than it's been in a while. We're 4 weeks into the school year. Uh, more responsibility is great, but it also comes with added time and more need. And between my job and my businesses and our businesses and finances and life and the really sad news we all got this week, it's just and the aftermath of Charlie Kirk passing and the aftermath of his martyrdom. It's been a much harder way to end a week. And did I get everything I wanted done? No. I had hoped to get through the entire master portfolio and update everything, and that didn't happen. And I have a lot of other projects I need to get done, but that didn't happen. So it's affirming the idea that every day is a new day and every day is another day to get stuff done. And some days you do need to take a break and recharge. But we just keep, I don't want to say plodding along, but it feels like that some days. So some days are sailing free and other days are fighting the wind the entire time. And part of that wind is you, and part of that wind is culture and everything else. So we take it one day at a time, we do the best we can, and we continue on into the next day. So I didn't get everything I wanted to get done this week, and that's all right because as far as I know, I have tomorrow and this week to get it done. Um, it's I know we all make plans for days and months and years ahead of time, but none of us know how long we have on the earth. So we do the best we can with what we're given, and some days we're amazing at that, and some days we're not. And some days we fail across the board of things, but you gotta get back up. You gotta dust yourself off and keep going. And it's the constant it's the mindset of never stop learning mixed with grit and hope and just this utter desire to keep going. So that's what we're up to. So I've got the video for the week. And it was a struggle initially to wrap my head around things because of all the other stuff just feeling like it's sandbagging me, and even my own doings kind of sandbagging me. So once I got going and you kind of combat lethargy with action, Once I got going, it got a lot easier to frame the week and frame a battle plan. So let's get into this. The market in general, stock market in general, markets don't wait for a permission slip. Car loans are now advertised for 1.75 APR. Mortgage rates are taking lower and bond yields are bending. And those are moves happening long before Powell finally hints at a rate cut. And the market's already pricing in what the Fed hasn't delivered. Now, could the Fed do it better? Yes. But the market's responding in advance of the Fed, which is good and also not good. Or at least it's good and it points at a deeper problem. But mixed in that, perception still drives behavior. The herd hears rate cut and immediately stampedes. They react to whatever they think is happening rather than the underlying data. Jobs numbers may be softening. Maybe we haven't had a great, accurate jobs report in years. It sounds like based on what the current news is. So the job numbers may be softening. Inflation is still biting at the grocery store. Trust me on that with our recent grocery bill. And the Fed talks and does nothing. And it's frustrating. I mean, as an average American, which we all are, right? Or we can just cut out the average. As an American, it's frustrating when our government doesn't respond or the agencies don't respond how we would hope they would respond to data. But regardless of whether the Fed responds or not, we still have a job to do. It's our job to ensure our investments, but also to ensure our retirement. And whether you're investing for fun money or you're investing for whatever reason between now and retirement, or you're investing now for retirement, it is our job to safeguard and grow our money. So, as strategists, we don't chase the headlines or the stampede. And quite honestly, we don't chase the Fed either. We acknowledge it, but we don't chase it, right? We watch the market moves and the data behind the perception. And that's where the opportunity really exists. It's in the spaces the herd hasn't recognized or in the spaces they're fearful of. I mean, honestly, when the herd crashes the market and that CNN FGI just dips into fear and extreme fear, that's an amazing time to look for a deal. But that's all the herd doing, or that's all stemming off the herd's fear. But instead of following the Fed and instead of following the herd, we focus on the sectors and the structures showing the most promise. We've got a big picture, forward focused, long term view, and we're using today's market to scoop deals based on that perspective. The twist of that is the dumpster diving, and the dumpster might have moved, but there are still deals and discounts to snag. Things aren't as cheap as they were, but the opportunities remain. We just have to know where to look in the new economy. And I will tell you up front, the tide has shifted. So we need to determine our own course and not wait on anybody else. So here's where we should be. Bonds and bonds proxies. So you get municipal bonds, REITs, BDCs, business development companies, utilities, energy infrastructure, all steady yields that help just reinforce and anchor a portfolio. We look at energy transfer, not necessarily production. So if you think about it, supply management drives opportunity, and then overproduction depresses prices. So in a world where we're trying to increase production, which would increase supply, that's not exactly a, an environment where I want to own the pump on either end. I don't want to own the derrick pumping it, and I don't want to own the gas station pumping it, but I want to own the between because that'll always be needed. We also look at tech and then US focused equity, which is really everybody throws the equity word around. It's really just a stock. Now, there's a deeper connotation, but it's really just a stock. So we want innovation, not necessarily an outright tech company, not necessarily Amazon, or that's great, but Amazon, Alphabet, Meta, IBM, what is it, ASML? Not necessarily those, but not exclusive of those. We want companies that are positioned to be profitable. I mean, that's everybody's guys, right? Like the goal is to make a profit, but we want companies that can really rise and compete in the current market and in the coming market. And that's like mid-level or low-level, or say mid-cap or small cap, where they're not heavily, this sounds bad, but they don't have a ton of employees. But the tech that they bring on can increase their production. They don't have a ton of employees, so they don't have a ton of overhead in that regard. So they have the most potential to really grow their overall wealth or grow their overall equity. Uh, and by if we position or say if we sit in these areas, then we act based on data and knowledge, not premise and supposition. We know where the market's going, or we can predict where the market is going based on past iterations of where the market's been, right? A looming rate cut means bonds and bond proxies are positioned to rise, but that doesn't mean dividends will fall, not in the closed-end fund world. And a rate cut would lift most other markets as well. That just means we're not we're not just hunting the best deals of today. We're also thinking about where things are going so we can adjust or adapt our strategy to also include where things are headed. And the herd is the herd. Um, they're steered. They are schooled like fish. They are herded like cattle. The herd will eventually follow, either because they're told to by those talk show circle junkies, or they'll get steered there based on articles that all say the same thing. But that's really what we want, which might sound a little crazy, but we want the herd to rush in and close our discounts, right? Because that'll just push share prices higher. And that gives us potential and opportunity to decide whether to stay in the stock or to sell it. But we're not quite there yet. For now, the herd waits on someone to tell them where to go. But we've already charted the course, right? They'll catch up eventually, and when they do, we're already there. We're just waiting on them to catch up. So we get there before them, right? So when we get there, it sounds kind of, I don't want to muddy the water. The herd arrives late and they leave early. They arrive late. The market gets greedy, the herd gets greedy, and they push money into a lot of different areas. That's good for us. They buy up shares, which then increase share prices. So you're decreasing demand, or you're increasing demand, you're decreasing supply, share value goes up. You're also decreasing the discount window, share value goes up. That's good for us. We want that. And then it puts us in a different place. Do we sell it and push the money forward and buy the next stratagem? Like looking down the road, where's the next place we need to be? Or do we hold the fund and let the herd push share prices higher and ride the wave? But in either case, we're not there yet. We're pushing forward, waiting for the herd to catch up so then we can play the next round, essentially. So, where does that leave us? Let's look at the list for the week and then we'll go from there. Share my screen. So I thought about doing a fast rundown like I did last week, but where I just gave you a list, but I haven't really gone through the entire process in this for a couple of weeks, so I wanted to go back and revisit that. So we have a lot of tabs, but we have the overall master list, all closed-end funds currently on CEF Connect. Anything that's in purple or green, I update every week. The entire list should be updated every month, but I've been forthcoming that I have not updated it at either the end of August or the beginning of September, just because of life. Um, so it's not purely updated, but it's as good as it's going to get right now. So in organizing this, I end up taking, nope, not that way. The triple asterisks, which would be buy alerts, and they are specific to each individual fund. And then we have dollar cost average that I didn't put on the options list for the week. And then I have single that we're just tracking for any number of reasons. So we come to the breakout list, and they're all significant discounts related to each fund's individual data. And it's triple because the existing discount, see a fund that's been away for or been around for a while, the existing discount is at least double the historical and it's greater than the 5 year. So it's got to have both, or it's got to be a newer fund where it doesn't just have the historical data. Like it's hard to give historical weight to a fund that's not that old. So the data is still significant. It just hadn't been around for that long. So as I rank these, the goal is monthly. The goal is a monthly payer. However, the exceptions to that are not every blue chip fund is a monthly payer. We own three. We own four outright stock funds or equity funds. One of them is a monthly payer. The other three are not. And I've talked about that at length, and I'm not going to get into it now. But of the options here, these two are going to stay. Powerhouse blue chip, great funds for the current market and for long term. So outside of a monthly pair, we also look at yield. And the goal is 9% or better, unless there's a good reason for keeping it when it's sub 9%. And of the list, HFRO remains the biggest discount. It's closed considerably in the last month. It used to be pushing 55 or 60% off. Share price was under $6, really like around 550. But with the hope of the coming rate cut, the herd is going, oh my gosh, real estate finally sounds like a really good idea, and things are changing. So it's still a great deal, but it's not as great of a deal as it was. NBXG, we currently own. It is. It's all stock, all equity, but it's also all 5G stock. The companies that will do well in the coming Golden Dome, golden infrastructure area or timeline between our battle between the U.S. and China. Let's see. ERH is utility. It's a bond proxy, but it has a variable dividend, and it's not. Honestly, I've owned an Allspring company, just not a fan. ADX is going to stay. As I looked at Eaton, so maybe a month ago, I looked at Eaton Vance, Calamos, uh, ADX, USA, ASG, and MBXG. And me personally, I like companies that are not afraid to ignore the command to diversify, meaning diversification for diversification's sake is like scraping butter over too much bread. Like I find it pointless. Spreading out your money so far that nothing really has a chance to grow it doesn't help anyone. And the fact that your company is diversified and you brag about it being diversified and it's so spread out, it's just not a good sell point for me. So that's not to say that the Eaton guys are bad investments. It's just to say that they're not my investments. I lean toward ADX, which last I checked, they had under 100 funds or 100 different stocks in their portfolio. USA's got a small portfolio. ASG has a small portfolio. NBXG has a small portfolio. So it's just not my style. Eaton Vance has like 600, and 600 for 600's sake. And I'm sure they have the reasons. I don't know what they are. I'm sure they have the reasons. So nothing against them. But I think, yeah, it's a different strategy. It's a different mindset. I'd much rather have a smaller focused portfolio where you can invest more into everything and not spread it out. So enough said, I think. TEEF is an interesting portfolio. TEEF takes all renewable energy and focuses on that and not oil. And they live by it. It's like their goal is to have all renewable energy and get rid of oil. But the problem with that is without oil, you can't have their products. So it seems a little misguided. Um, Now, don't get me wrong. So, like every solar, let's see, solar, water, not wind. I'm not sold on the wind production. But solar panels, uh, hydroelectric production, I think those things are important given the right setup. Like if you're off grid, a solar panel sounds amazing, right? And if you've got a stream, hydroelectric power seems amazing. But you're not going to sell me on the windmill part. Uh, DLY is interesting in the sense that it's got a greater discount than it has had. Uh, and we own the sister side, we own DSL. DLY has a very different portfolio. Uh, it's just a little more pricey than DSL, but it'll stay on the list for right now. CIF is um, it is a super highly concentrated corporate bond portfolio, but it's on the smaller end of total investment compared to say FSCO, which is it was like 2.6 billion in management. Um, CIF sits around 50 million in total assets, and it's a very much roller coaster ride. CIF very much rides the rate roller coaster, and we bought it knowing that, but at the same time, I'm not a huge roller coaster fan. Um, so it's not going to stay on the list. PDO is generally a great buy when it sits around the discount, and that's it. I know I preach discount, but PDO is one of the exceptions. There's three exceptions really, but PDO is one of them. So it'll stay on the list just because it's a little higher than the current overall 1 year average, but it's close to it. USA will stay. Yes, it's a quarterly payer and it's an off quarterly payer. I mean, based on that, so pay if it's a category one payer, it's 14710. Category two is 25811. Category three is then 36912. So it's like an alternate category three, but it's still a quarterly payer. Um, and it also pays a solid dividend. Bonds, it's got to be, in order for us to add a bond fund, it's got to be better than what we already have. And these hybrid funds are great, but they also have a caveat. All the other part of this is I'm much more interested in investing into the US than adding foreign investments. Now, if I did, I would pick a different bond fund. But that bond fund also doesn't make the list this week. Um, but in adding funds, so like if we added DLY, it's got to be better than what we already have, or different than what we already have, and it is. PDO is the same way. I have not dug into these, but we already own three Nuveen funds, although all three of them are municipal bond funds, which is different than what these are set up as. They're still not going to make it. The CLO market space right now is it's kind of like an orange flag. Um, we bought OXLC, and my video last week talks about OXLC having a price um, inaccuracy. No, I was wrong. Google AI was wrong for that matter, but I was wrong. That is the price, although the dividend was off. OXLC did a reverse 1-to-5 split in order to decrease their discount and increase share price, which happened. But I don't know if I'm a fan of it. It's and it's been around for just this past week, and I get why they did it, but at the same time, I haven't heard the full decision of why, like why it was necessary. It's still on discount. It still pays the same yield. It's still like I get it. It pays a higher dividend than 0.09, but at the same time, it's now valued higher than 375. So instead of owning 1,000 shares, we own 200 shares, and we get pretty much the same dividend. So I don't like it, but I don't know how that's going to go. And with OXLC being one of the bigger names, longer standing CLO management funds, it makes me question the rest of them because the rest of them have not been around as long. So even though CLOs sit inside that bond proxy umbrella, or I guess, or sit under the bond proxy umbrella, I am highly hesitant of CLOs at the moment. And I get it. They are tranches or groupings of debt that would do better in a lower rate market. I completely get it. But based on based on the CLO market space and the investors inside that space, it makes me hesitant. And I've learned I've learned that my personal feelings about stocks don't always mirror where the herd is told to go, which sounds like it should be an apparent thing because of how I frame the herd in my videos and how panicky and crazy they seem. And is think of how I want to say this. Yeah, how I feel about stuff isn't generally how everybody else feels about stuff. So I give you my advice based on what I'm doing for us and the rationale and the reason behind it, knowing that not everybody else is going to say the same thing. And that's partly what I mean in that I often walk alone. And you've got to be comfortable in that. Not in my ability to walk alone, but you have to be comfortable in your ability to walk alone. So that if I see a buying opportunity for a coming market and the herd is way off in left field and what we buy is super low, might or might not have a rising dividend, it's kind of like, why are you buying that? It's because I'm trying to anticipate the coming market before the herd gets a whiff of it. And that's not to say that I'm like in foul territory in the stands. That's just I'm in a different place than the herd is. And I'm not fearful of the CLO market. But at the same time, there are a lot of people afraid of the CLO market and default rates and high interest rates. And it's a weird space to be right now. So for on my end of things, I don't want to go near the other companies because they haven't been around as long. Their prices have pretty much hovered. Um, and for the biggest name or longest standing name of the game, at least in the closed end fund space, is suddenly changing their strategy. It makes me like perk up my ears, but at the same time hesitate on buying anything more. Additionally, we bought it at like 340. We snagged a deal, and currently, when it transferred and split in that reverse split, I think interestingly. So our our Roth account still has housed at Webull because I'm figuring out how to transfer it out of there, and then the brokerage account, like cash money account, is housed at Fidelity, like the tab says. Um, and it split the same day, and it should have split for the same price. But the Fidelity price was like $20.08 a share versus the uh, Webull price was almost 80 cents higher, which just doesn't make sense. So at split, the price was $20. Since the split, it's dropped $3 and change. That doesn't exactly broker any confidence in me buying more of it. And you could argue and counter, hey, you're always talking about buy other people's fear. Yes, I am. But at the same time, I don't know enough to buy that fear because it could still go lower. I am all for buying a good deal. The discount that's there, it has existed for the last week. That's not exactly a lot of data. And that price is relative to the last week. That's not a lot of data, but $3 drop in the last week is eye catching. And to have not heard a dicky bird out of OXLC for why they did it outside of decreasing the or outside of improving the discount and supposedly improving the price makes me hesitate. So for now, I would pass on CLOs. Now, maybe that changes. OXLC sent an email saying, hey, we're going to have a meeting. Maybe I learned something beneficial in the meeting. Maybe that changes my mind. Maybe not. But for now, not an option for me. Let's see. HGLB has not been on my favorites list, but they do have a midwave wireless, a huge midwave wireless investment, which is probably the uptick because I want to say Starlink or I want to say Starlink or SpaceX One just bought a lot of midwave wireless, not from the company they own, but in the midwave wireless space. So maybe that changed their value. BRW is dipping their hands into another pot. I got an email from Meggie, which is a utility fund, asking for votes for the upcoming election. And Saba Capital is contesting the board being promoted by the Meggie board or MEGI board. And they're doing things that I like. They are attempting to decrease the discount. They're attempting to increase dividends and also increase price. I like those things. I like that other funds are being challenged to benefit shareholders like they're supposed to, like we'd all love them to do. I mean, we're buying companies we want to reward. We we are we own shares. We're shareholders of that company. We want the company to do things that benefit us. And BRW and its overall body, Saba Capital, is doing that. 813 is higher than it's been, but it's also lower than where the 850 was like its going price the last 2 weeks. So 813 by comparison is cheaper than 850, but it's also higher than our average. Discount wise, it's one of the lower discounts. It used to sit around eight. Um, but again, we're dumpster diving, but we're not exactly dumpster diving in the same dumpster anymore. River, honestly, and BMS too, it sounds like a great portfolio, but I'm not a BlackRock fan. I love how this H keeps disappearing. Um, so BMES is out for me because it's BlackRock, and River is out because it's also BlackRock. And the difference is BRW is trying to force BlackRock to pay shareholders more, meaning they bought BlackRock with the intention of forcing BlackRock to change. I'm okay with that, although I'm not a fan of owning BlackRock through BRW, but at the same time, River is not doing anything for shareholders that I know of. Maybe they are, but they're also not combating BlackRock. So they have BlackRock because it's a good financial deal, maybe, versus BRW is doing it for shareholder value. And then Hicks is great, but it never really outpaces the benchmark. So you can get it cheap, and it is on a discount, and it pays a great dividend, but it's not really going to treat you well. So that leaves us with this list. RLTY, I skipped over. It's a 3-year-old fund. The current discount, yes, is it sits lower than where the average has been. You're paying 15 bucks a share for it. It's got a fantastic portfolio. I mean, a fantastic portfolio. And I want to say it's mostly, I want to say, so we own IGR, which is a global real estate group. We own RFI, which is a North America based real estate group. It's got other stuff spread out, but it's primarily North America. And then we own HFRO, which is a US based group. So adding RLTY, if we added it, would give us another way to continue to invest in real estate because between RLTY and RFI, they're not always on discount. Uh, that being said, 3.62 is not like it's in the ballpark of the 1 year average, but it's not ideal. It's also significantly lower than 9. So it's kind of up to you. HFRO, US based company, like US based in the sense of it's investing only in the US. Um, RLTY, more North America. The others just don't make the list. So where does that leave us? Well, the focus is bonds proxies, which would be so you have municipal bonds, BDC, utility, energy transfer, oil doesn't make the list. You have real estate, then you have outright tech and stocks. I'm still, this is me. I get their prices gone up. 30% investment into a mid-wave wireless company just seems like a lot. But for us, I mean, $9, I can go back and show you. $9, $1.20 up, yeah. I'm not exactly wanting to add more, knowing it's going to bite or say raise our average stock price that much. So if it's me, and I thought of this before I sorted, and I didn't know how the ending would go. If it was me, what would I pick? I would pick US stock and I would pick bonds unless there was a better option. And in the list, we've got bonds plus some hodgepodge, but we have bonds, we have stocks, bonds, real estate, blue chip or stocks, and real estate. Any of them are great options, but you can't buy everything. And we're not investing tomorrow. I still feel like I've got cluttered headspace. I've got too much going on that it's hard to think strategy beyond where my focus has been. My focus has been writing books and getting our monthly finances tracked and in order, and then considering other investments in the sense of like, what do we have coming up that we might need to take care of that would draw money away from my ability to invest that money? And if I can wrap my head around that stuff, maybe, hopefully, I can figure out and get better clarity of where we should invest. But if you were going to force me to invest tomorrow, if you were going to outright force me to invest, which you wouldn't, but we'll play the game, what would I pick? I like PDO over DLY simply because it's cheaper. It's a PIMCO fund. It's not on discount, but it's close to break even. But it's cheaper in price and you get a slightly better dividend. And it's got PIMCO name. And in the both funds, I think like if you could buy both, that's a great option. But I still like BRW because we already own it. To buy something we don't already have in a market where we're dumpster diving in kind of I want to say mid-level pricing, but we're definitely not dumpster diving behind the 99-cent store anymore. So if we're really trying to snag deals in the current market, looking ahead, if rates really do get cut at the end of the month and the herd really does sign on and start buying bonds, then we're kind of at the end of the bond bull, which means you can find a discount and you can find a decent price, but you're going to be paying higher for that than you were, say, 6 months ago. ADX is higher than what I would like. USA, I still think is a great deal. And you only have so much money. So what would I pick? It's honestly, it's like a crapshoot. It's really a crapshoot knowing what we already have. That's a great deal, but higher. That's a decent deal, but higher than our average. We don't have that, don't have that, don't have that. That's a great deal and not much higher than our average. So USA would stay. BRW would be the most expensive batch we've bought, but it's not that much higher than, say, $8 of where we bought before. So where do I think things are going to go? Would adding another bond fund really help us at this point in the game? And for the existing market and the coming market, maybe. Simply because if I'm buying brand name on discount, and if I'm going to own it year in, year out, regardless of market, knowing it's going to fluctuate in price, maybe. Additionally, I don't know when the next bond bull will happen. Everything's a cycle, and I'm okay with waiting, but I don't know when the next bond bull would happen. So if I passed on bonds, I would pick probably Realty and HFRO. I would buy BRW USA and then Realty HFRO. But if I didn't pass on bonds, hmm, it's a conundrum. It really is. It's all the more challenging because I'm not buying. But let's see if I can narrow it down without wasting your time. All right. Action over lethargy. By the PIMCO name, we own Double Line already. It's a different fund. Yes, completely. But we already own a Double Line fund. We already own a Cohen and Steers fund. So does it give us much difference than what we already own? Not much. The difference right now is that it's on discount. So if everything was on premium and you wanted to focus on discount, that's the easy way to narrow it out. And if we're buying value, NBXG is higher than it's been, which is great. But USA is not much higher than our current average share price. So I would stick with these four: bonds and some other stuff, plus a shareholder activist fund. And I like that. It's not as big of a discount as what it was, slightly higher price than what it's been. So if those are enough to turn you off, then just cross it off your list. USA is still a great value. PDO has a decent price. They still pay a above 9% dividend. It's trading about on par for its par. I get that it's premium, but it's pretty much always premium. So to buy it close to break even for it or close to where it trends is pretty much a break even deal. And then HFRO is still a US based investment. And if I'm pushing a US based investment, it seems a little contrary to buy a real estate fund that's not a sole U.S. based investment, or at least not a majority. And RLTY is a majority U.S. It's a majority North America, but it's still a global thing. So if I'm going to push USA based investments, I got to follow through with that. So I would pick these four: BRW, USA, PDO, and HFRO. Enough dilly dallying, perhaps, maybe. We'll see. So if you found value in the video, hit the like button, drop a comment, and help me hack YouTube. But also, let's hack it together. So liked videos, shared videos, and videos that have comments get pushed out into the algorithm more. As a channel, when you do those things, you also get more views. So let's hack YouTube together. And before I sign off, one last piece of advice, uh, related and unrelated to the market. After a very tumultuous week, after a very stressful week, I cannot close without saying this. And the week still weighs on me. Still weighs. Take some time this week to focus on just you. And ideally, you do it every day. No distractions, no outside noise, no videos, no scrolling, no music. But I get it. Like if you're alone and the silence just bothers you, that ought to clue you in that you've had distractions for way too long. But if you got to play some kind of background music, play classical music, something that won't distract you, right? So take time for you. No distractions, no outside noise, just you, your thoughts, and your prayer life. Our lives need clarity and we need truth. And there is no better lens than a Bible. Take the time while you have it. Use the time well. Do the best you can with everything. And if you fail, get back up, dust yourself off, keep learning, keep growing, and keep going forward. So I wish y'all a great week. This is Daniel Young signing off. I will see y'all again, or hope to see you again next week. Bye bye.